Well, the most significant result of the week was Wesfarmers' $1.6 billion profit. It was a 2.8% improvement on last year, and while the coal business was disappointing, retailing was pretty strong. But that situation may well switch this year. And while profits were up, the return on equity, which was already about a quarter of what Wesfarmers used to produce, deteriorated further. I spoke to Wesfarmers chief Richard Goyder a few days ago. Well, now, Richard Goyder, just bear with me on this. Coles made a profit, earnings before interest and tax, of $962 million, capital employed of 14.8, and that's a return on capital of 6.5%. Bunnings' return on capital was 30%. Now, I figure out to make a return on capital like Bunnings, Coles would need profit of $4.4 billion. Its EBIT to sales margin was 3.2%, which means that to make that profit, it would need to sell in sales $137.5 billion worth of groceries. But total food sales in Australia last year were $87.5 billion. So doesn't that tell us that it's basically impossible for Coles to make the sort of return on capital that Bunnings is making?
Well, Alan, you don't need to make a 30% return on the invested assets in Coles to make a decent return for our shareholders. And I think the important thing is that we're now seeing improvements in return on capital in that business, and we'd expect to see that in the years ahead. If you think about the capital employed at Bunnings and the capital employed at Coles are quite different. The capital employed at Bunnings is a historical cost and depreciated assets, and the capital employed in Coles reflects the purchase price of the business. And so one's much more a market value than the other. And in both businesses over the coming years, we'll be looking to improve their return on capital. And if we do that, we think our shareholders will derive significant wealth from both businesses.
Yeah, but Wesfarmers as a whole used to routinely make 30% return on equity. I mean, the year before you took over Coles, it was 25%. This year's return on equity, because of the low return from Coles, your ROE was 6.4%, down from 7.3 last year. So, I mean, you're never going to get back to what you were earning on equity, are you?
Well, we're not targeting 25% return on equity, Alan, because, as I said, absolute numbers actually don't mean anything because it depends on what your equity is. But we're certainly targeting an improved return on equity over both the short term, medium and long term. And we're pretty confident we'll get that. And as we do that, we think the most important thing for shareholders, which is total shareholder return, will be good for shareholders, which it has been for Wesfarmers, not just over the 26 years that we've listed, but in fact, if you look at our total shareholder return since we acquired the Coles business and since the collapse of Lehman Brothers, we're ahead of the market on both fronts.
And that's based on your share price, right?
It's share price and dividends, returns to shareholders. And that's what matters to shareholders, is the capital value of their shares and the returns they get.
But you can't maintain healthy share price growth and dividends without a good return on equity, can you?
Yeah, no, I agree. The two are absolutely linked. And so, as I said, we're certainly targeting improved returns on equity. We're not happy with the current level we've got. But with the turnaround opportunities we've got in Coles, Kmart and Officeworks, an improvement certainly this coming year out of the resources division on the back of higher export coal prices, we'd expect the group return on equity to improve and to improve over time.
Well, to what? I mean, anyone can improve profits by throwing more and more capital into a business.
Yeah, I agree. And I'm not going to disclose what our targeted return on equity is, but it's certainly higher than what we're achieving at the moment. And we'd expect the divisions in Wesfarmers to, in due course, all be achieving above a 10% return on capital. The group return on equity should be higher than that, and I'm confident we'll move down that path, or we are moving down that path now.
Well, the turnaround in Kmart has been quite spectacular, but has that been a one-off thing with the reduction in products in the stores accompanied by an increase in volumes, and is it sustainable?
We're really delighted with the progress so far from Kmart and Guy Russo and the team. And you're right, they've reduced the number of SKUs in the business, they've simplified the business, they've cleaning up the stores and getting a much better proposition to customers. That will continue with a very strong focus on value for families. And, so this year's all about continuing down that path And part of the challenge with Kmart is to ensure that on fewer products we've actually got the quantity to sell, because the customer's reacting well to the proposition they're getting. And we'd expect to see continued improvement in Kmart. There's still a lot of work we can do in supply chain and on costs in the business. And so from a profit return point of view, we think there's a very good story into the future for Kmart.
You're in a unique position, Richard Goyder, running a national business from the resource estate in Perth, retailing all over the country, coal as well, and several other businesses. So how do you see the business environment and the economy in Australia at the moment, and what do you think are the key issues for the future? At the moment, relatively speaking, the Australian economy is pretty solid. You've just got to go overseas, which I'm sure you have, to Europe and the US to see that this economy is comparatively in much better shape. And so it's a good place to be doing business in. And I think, having said that, there is some uncertainty amongst consumers at the moment because high interest rates, pre-election, a bunch of things. And so we'll watch that. We've had a bit of a mixed bag of results, performance thus far this year, with the businesses that have got turnaround opportunities performing relatively better than the more mature businesses, as you'd expect. I think that the challenges for Australia are to ensure that we've got an environment where business is able to create wealth, because if you create wealth you can then spend it and allocate it and do the nice things you want to do, and that means having an efficient tax regime. It means making sure we've got productive workplaces. It means making sure businesses are able to be innovative and use their initiative and be creative. And I think we also need in this country continued investment in infrastructure, both hard and soft. And hard, by hard I mean, port and rail and water, and in soft I mean health and education, because I think that's, it's very important to us as a large employer that we have well-educated and healthy people working for us. Thanks for joining us, Richard Goyder. Thanks, Alan. Good to chat.